G'day everyone, welcome to this global update for the 14th of September. And just in the last couple of days, we've seen some weakness come back into global markets. There's plenty of triggers for that, of course, in Ukraine and Middle East. And throughout the last couple of months, markets have largely ignored those triggers. Now we're getting a little bit more of a reaction to that, but look, it still only looks pretty mild to me at this stage, so I don't think it's anything to be concerned about. And in fact, a bit of a pullback would be healthy because it's actually a little bit challenging to get some good trading entries at the moment. So a little bit of weakness is probably a good thing. So let's have a look at what's happened in global markets during the week. The S&P ended up declining 22 points, and half of that was on Friday night. So there are just a few signs of mild weakness. As I said, it's nothing really of any great significance. And I'm looking at targets. If we do get a little bit more selling, I'm looking at some targets around about 1971 on the S&P, and the other possible target is 1959. Now the market closed 1985 on Friday night, so it's not that much more. Another decline as we had last week would pretty much get us there. Now I did notice though that going through a few hundred charts of American stocks, that a high percentage did decline on Friday night. It was probably something close to 85 or 90%. Now none of them went down to any great extent, but it's just I think a bit of a sign that so many went down and so few actually went up. So let's have a look at the American market. So this is the S&P. As you can see, if you look at the red moving average line, the 150-day moving average line, it's still basically unchanged. You can see there's really no change in the gradient of that line at all. The index is still significantly above, which is indicating strength. So there's been absolutely no change in the character of the market. Now, I don't know what you read, but I read plenty of things from all sorts of different sources, and there's lots of people calling for a major correction, have been for a long time. I think they're doing it purely because the American market has gone up for so long, and that's hardly a basis to call for a correction. So no change in the character of the market, just a little bit of easing you can see on a couple of occasions last week, and they're the two likely target levels, which are just below where we finished. So nothing terribly dramatic in the American market. Let's just have a look at the Russell 2000. This is the small cap stocks. So not as buoyant as the S&P. We're in a period of consolidation, which really started around about January. So pretty much all this year, the broader Russell 2000 market has largely just gone sideways, while the S&P has pushed on to new highs, thanks to gains in some of the big stocks, particularly stocks like Apple and Microsoft. But nothing unusual about that. That's just the way that markets work. Moving on to the Australian market, we had a pretty poor week. The index was down another 68 points for the week, and I think what's happening here now is that the falling Australian dollar is now starting to have an impact on stocks. If you're an overseas investor, and more than half of the Australian buying is made up by overseas investors. So the direction of the ASX 200 is not really controlled by what happens within Australia. It's overseas investors that heavily influence the direction of the index. So if you're an overseas investor and you're seeing the value of the Australian dollar start to break down to the downside, then it's only natural that you're going to start to trim some of your exposure. And where the major international fund managers have their exposure, of course, is in the top 10 or 20 stocks. And that's one of the reasons that our banks copped a bit of a whacking last week. And this has been, I think, a long time coming. The banks are fully valued, perhaps even overvalued, looking at where the Australian economy is headed. So it's natural that there's going to be some selling off of bank stocks. However, despite a falling iron ore price, the major miners actually gained a little bit. They dipped early in the week, but had a pretty good turnaround towards the end and actually gained a little bit of ground. So people playing the contrarian play, I guess, on the major miners, figuring that they've been sold off far enough. Now, commodities, gold down heavily on the week, down $40. Part of that was currency, so part of that was strength in the American dollar, but part of it is just, again, selling in gold. And it's really hard to reconcile the supply and demand fundamentals with what's actually happening to the gold price itself. So it's now broken support of the uptrend within it's still in an overall stage 1 base. So we haven't broken down, but we certainly have broken the shorter term uptrend that was occurring in gold. So that's not really the sign that I was looking for. Now, stocks were down, gold stocks were down mildly, and the GDXJ, which is the junior index, or the index of junior miners, actually did a bit better than the top 10 or 20 biggest gold stocks. So that's a bit of an encouraging sign. So hopefully we're not too far from the bottom on gold stocks. Silver also outperformed gold. So silver fell, but not as much as gold did. So again, a little bit of a sign there that hopefully there's not too much more downside in this. Copper slipped back to $3.11. It's still at a pretty buoyant price, and that's really largely about US dollar strength. I don't think anything else much is going on there. And of course, crude oil down to 92. A little bit of that is currency, but a fair bit of it is the fact that the world is now producing more oil than basically what it needs on a day-to-day basis. So that's having an impact on the crude price. And it's hard to see what would drive the crude price back up above $100. It would take one heck of a blow up in the Middle East, I think, to have an impact on the crude price. And I wouldn't be surprised to see crude oil back down at $80, somewhere in that vicinity. So let's take a look at the Aussie dollar. The Aussie index, the ASX 200 index. So you can see it's still tracking slightly higher. Nothing like the American market. So the red line, the 150-day moving average, still heading higher. The index is still above it. So we're still in uptrend, but it's a pretty mild sort of uptrend compared to what's happening elsewhere. A little bit of a turnaround, a little bit of buying on Friday, and it was really about the major miners. So we'll look at, this is the mining index. So this point here was last Friday. So you can see we actually finished up a couple of points towards the end. But it was the banks that were actually sold off. But again, nothing dramatic, just really coming back towards the trend line, and that's nothing much else is going on there. Now turning to gold, this is gold on a daily basis. So you can see the last 3 days of the week was quite a concerted fall in gold. It's now oversold. So I would expect a bounce at some stage next week. But if we look at this on a weekly, you can see we're still within this overall phase 1 base, but we did have an uptrend going. But that uptrend got broken during the week, and reasonably emphatically. So we really need gold now to hold this just under $1,200 mark. It finished the week at $1,228. But if we look at silver, not down as heavily as gold was in percentage terms. Turning now to the GDX index, yes, gold stocks were down. They actually led at the start, and then gold, the price of gold fell and accelerated past that. The gold stocks did a little bit better towards the end of the week, which indicates to me that there's probably not too much more downside in the price of gold. Now this is a GDXJ, as you can see, and it only lost a very small amount on the week, so that's an encouraging sign. There's the spot copper chart, still basically in a broad sideways consolidation. That's nickel. We had a bit of a spike a week or two ago when there was news about the fact that the Philippines might join Indonesia in banning nickel, unprocessed nickel exports, but it declined again last week on the currency effect. So just to wrap it up, September, still a time for caution and positioning. The best time of the year starts sometime in October, and we've then got a pretty good 6 or 7 months ahead of us. So This is a time for caution and positioning. It's where you need to be patient. Don't try and force the market. Don't try and force things to happen. Just let the market come to you at a price that you're confident about. Now, if you don't know what price you should be confident about, then there's certainly plenty of assistance that I can give you in that department, because effective trading and investing is all about having done your homework and really understanding where the value is and being confident that the odds are heavily in your favor. So if you'd like some more input in respect to that, there's information on our website. There's my email address. Always happy to communicate with traders and investors. That's it for this week. Cheers.